There's one single chart that has a 97% chance of accurately predicting if the market's going to go up or if the market's going to go down. Just think about that, a 97% chance. And it took me over a decade to figure this out. So if you're watching this video right now, you're pretty lucky because, this is 10 years of me making mistakes, looking at the things that don't matter, to bring it into this video to show you the one single chart that does matter. And this is the exact chart that scaled me to a 7-figure account in a low risk way. No day trading, no swing trading, no doing all these crazy option strategies, no staying up at night, all night long wondering, oh my God, is my trade going to work out or not? We're not going to do all that stuff. We're not going to play those games. We are going to do stock options, but we're not going to do it the way that most people do it. And this chart is going to teach us exactly when to deploy bullishly, exactly when to deploy bearishly, and how to simply capitalize on what the market is likely to do. All right, let's dive in. Alrighty, so let's head over to the charts. And honestly, I'm like so pumped to go through this with you guys because not only does this chart have roughly a 97% success rate, but on top of that, it works on any company. It works on any ETF. So if I show you the S&P 500 or Nvidia here, whatever I decide to show, it doesn't matter. This is going to work to every single company and every ETF. And I guess before we actually do the chart, I want to talk about one thing really quick because you have to understand this or it's not going to make sense. The number one thing that moves the price of a stock in the long term is what the profits do, is what the earnings per share does. If the profits go way up, the stock is probably going to follow that too. We all know Nvidia stock's been going to the moon the last couple years, but it's also because the profits have been going to the moon also. So what we're going to do on this chart is we're going to start out on the S&P 500. And what we're going to do is we're going to draw a line, and that line is going to correspond to what the profits are actually doing. And I'm going to show you the math behind how we actually do the line so that you could go do this on any company you want. And then we basically say, when the stock is trading quite a bit of ways above the line, the stock might be overvalued. And when the stock is quite a bit below the line, the stock is probably cheap. And then we're going to use this information to simply make money. We're going to deploy options in a way that makes the most amount of sense to capitalize on earnings per share growing and to capitalize where the stock is at in relation to where the earnings per share is currently at. I know this might not make sense right now, but this video is honestly pretty simple. It's not too detailed. And by the end of it, you're going to know exactly what to do and how to do this on any company at all. So let's do this on the S&P 500 first. All right, so very simply, the first thing that we're going to do is figure out what were the S&P 500 earnings per share in 2020. We're going to do this all on a 5-year basis. They're 117 per share. Right now, it's roughly $224 per share. So when you divide those two things together, it's roughly a 91% difference of earnings per share going up. So we're going to understand that. We're going to say, well, in theory, the S&P 500 in that same time frame should have went up by roughly 91% in the same time frame. So let's find out what it actually did. So I'm going to go from right here to right now, and remember 91%. What did the actual market go up? 101%. So we're going to understand that. We understand the market went up 101%, but the earnings per share only went up 91%. So I'm going to bring this down to where it says 91%, and then I'm going to draw my line. And before we draw the line, I just need this to click for you right now. The market went up 101%. The earnings per share went up roughly 91%. So they are still very correlated, but there is a discrepancy there. The market went up more than what the actual profits went up. Maybe that will indicate the market's a little bit expensive right now. On top of that, we are going to simply use these short-term discrepancies to capitalize. We're going to capitalize when the market's expensive. We're going to capitalize when the market is cheap. We are going to use these short-term inefficiencies in the market to deploy capital when it makes the most amount of sense. Long term, we know the market's going to follow what the earnings per share does in the long term. But in the short term, like a couple year basis, it's going to go like this above and below the line. So we're going to capitalize when we get those inefficiencies in the market. And to be honest with you, there's always inefficiencies out there. So let's draw the line. All right, here comes the line, and we are going to see how it looks. Bottom left to top right, we're going to end right there, 91% growth. Market went up a little bit more. We get it. But this line right here, this golden line right here really is the golden line. This line corresponds to what the actual profits of the S&P 500 did in that time frame. This line is going to give us critical insights into is the market over or undervalued at a given time. Maybe the market's expensive right here. Maybe the market's cheap right here. We're going to go into that stuff. But before we do, before I show you the exact trades and option plays that I would make when the market's hot or when the market's not, I want to show you a chart that would have predicted what happened in 1999. You would have known that the crash was going to come simply by basically doing this exact same thing. I'm going to put myself right here in the middle, but honestly, I'm not in a way. Don't worry about it. So what we're going to do is we are going to look at what happened with the S&P 500 here, which is the red line, and the blue line, which is going to be the same thing, the earnings per share growth. And we're going to draw some conclusions of, hey, maybe if we would have looked at this chart before in the past, like in 1999, before it even happened, maybe we would have not had our money heavily in the market when that did happen. So let's take a peek. So we'll just say the bottom left right here is roughly, we'll call it 1994. There's a little bit of distance right here. The market is below what the earnings per share growth line's at. Earnings per share growth line is blue. The S&P index is the red line. So the market's considered to be a little bit cheap in this category right here. But then the lines overlapped and everything kind of went downhill from there. The market became overvalued in this category because the more that the market went up at this pretty much vertical trajectory, we could call it, it became more expensive because the earnings per share growth line was going a lot more sideways than vertical. So as the market's getting disconnected from where the actual profits are going right here, the market's becoming more expensive. The market became a bubble and the market popped. And lo and behold, if we go down to the right, you can see where the market bottomed out right here. Let me move myself over a little bit. The market bottomed out pretty much right where the earnings per share growth line's at, and then the market followed it back up. That is exactly what happens in the long term. That's why this video literally says 97% win rate, because most of the time the market's going to follow what the profits do in the long term. And then let's just look to the right and see what happened with COVID. The market was a little bit disconnected right here. Market was a little bit above where the actual profits were at. So not only did the market correct back down to where the profits were at, but the profits also fell. So it's like a double whammy negative right there for what happened in the stock market. And the market fell pretty quick, pretty sharp. Now, what you have to understand is these lines overlapped right here. But what happened is the market rebounded way faster than what the actual profits did. So when the market had a little bit of disconnect right here, the market was quite a bit above what the earnings per share growth line was at. The market was a little bit overvalued. So all you need is a catalyst up here. All you need is some sort of bad event that causes the market to correct back down to the earnings per share growth line. And that's exactly what we got. Coming out of COVID, inflation was a little bit hot, ran up to like 9%. That is really hot, honestly. And the Fed was forced to raise interest rates. So the negative catalyst was the Fed raised interest rates. It's not the end of the world, but it does matter. So while the market's expensive, at a time that you get a negative catalyst, the market fell. And guess where the market fell to? Right to the earnings per share growth line. So then the Fed said, okay, inflation's starting to cool down. We're going to start to slow down interest rates. So then the market's been ripping higher. But notice what's happening right here. Notice where the earnings per share growth line's at, and notice where the market's at. Kind of looking to the left, it looks very similar. It's not as much as right here, but it is a little bit, and we do have to worry about that. And I'm going to build on this on one more chart before we go back to the chart where we drew that line, because I just want you to see this on another chart just to kind of like build a little bit more conviction in why this matters so much. Just look at this chart from high level. Don't even understand what's going on. All you see is two lines that look squiggly and they follow each other in the long term. The darker line is the earnings per share of the S&P 500, and the lighter line is the S&P 500 itself. So it's very obvious. The market is following, the S&P 500 is following what the actual profits are doing. I know I'm just talking about the S&P right now, but this literally applies to every single company on planet Earth. The profits matter. If you buy a company straight up, how much money do you make? If you buy a company for $1 million and they make $100K profit, how many years is it going to take me to get my initial investment back? $1 million purchase price, $100K profits, it's going to take you 10 years of current earnings to make your money back. That's a PE ratio of 10, by the way, side note. But we're going to go back to the chart and we're going to understand how do we deploy and how do we make money and how do we do this 97% of the time. Pretty much all of the time. It's pretty crazy how good this works. Warren Buffett's talked about this before. Like, this is a very known thing, but most people just simply don't do it. So when a market's up here, this little disconnect right here from the earnings per share, the market's a little bit hot. We talked about that. This is when inflation went high, the Fed raised interest rates, and the market fell. But then the market fell to an undervalued category right here. By the way, these are two different charts from two different companies, and I do these charts myself. They all look the same. The earnings per share was higher than what the actual index was here. So we could assume that the market's going to not only rebound to where the earnings per share growth line's at, but the market is eventually going to follow the growth line higher. So this is a time to be bullish down here. But up here where the market's at, you don't want to be super bullish unless something else is happening, which is what we're going to talk about in 1 second. I don't want to introduce that factor yet. What I want to do is let you understand crystal clear that when the market is down here in this category, it is largely undervalued. And when a market is up here in this category, the market is grossly overvalued, meaning it's just probably overvalued, and the future expected returns probably aren't going to be that good. So what we're going to do is go back to this chart, and we're going to talk about how we could deploy our capital in a way where it simply doesn't matter. It doesn't matter what the market does in the short term because we are just using the market volatility to our opportunity to capitalize on this stuff. That's all we're doing. It's not hard. You don't have to do all these short duration plays before earnings come out. You don't have to do 1 month call options. You don't have to do 1 month cash secured puts because nobody knows what the market's going to do in the short term. You have to understand this golden line right here. The profits are going up and to the right in the long term for most companies. Of course, some companies it doesn't. Go look at BlackBerry, for example, and when the iPhone came out, they crushed BlackBerry. You get my point. This only really applies to quality companies that are going to continue to grow into the future, which honestly is like, it's not hard to find companies like that. So when you have a company, let's just take Liberation Day tariffs, for example. When you have the S&P 500, where it was 21% below where the earnings per share growth line was at, do we think that that would maybe be a good time to deploy a little bit of capital? Do we feel like not only the market's probably going to rebound back to the growth line, just think of it as like a rubber band, and when you stretch this down right here and you let it go, it wants to fling back up. Do we think it's logical that the market's probably going to rebound back to the earnings per share growth line? Yeah, of course. And then when the market's a little bit hot, do we think it's logical for the market to want to correct back down to the earnings per share growth line? Yeah, of course. But the way that this dynamic actually works is it sets investors up for this major trap. The major trap of they're doing the wrong thing at the exact wrong time. They want to buy when things are high and they want to sell when things are low, simply because they're getting emotional and simply because you're panicking. This is so common for retail investors out there. So while this market is falling right here, let me clear this line off here. Most investors are panicking and freaking out. They want to sell their shares. They want to buy put options. They don't want to do any call options. They don't want to do any of that stuff. They're freaking out. They're heading for the hills. They're never doing the stock market again. But smart investors have this line plotted on their charts at all time. And they understand that, hey, the market's below the growth line. We understand that while there might be some more negativity that happens in the market in the short term, we know that even if we buy right here, we're getting in at a good level. If we buy right here, we're getting in at, of course, a very, very good level. So this doesn't even require you to time the bottom of the market perfectly. Like if you would have just bought anywhere in this time frame right here, anywhere where you're below the earnings per share growth line in this couple year period right here, and you held for a few years and you knew that the market was likely to rebound back to the earnings per share growth line, you would have done fine. Any single time period right here, if you would have just had a longer duration and you bought when things were cheap, you would have done fine. You could have bought leap call options right here, 2-year call options right here I was buying. You could sell 2-year puts right here. I was selling 2-year puts. I was not doing cash secured puts. That's why I talk so much crap on them. I was doing portfolio secured puts. Because if I know this market's undervalued right here, why would I want to sell puts secured with cash? I want to build a base portfolio in something like the S&P 500, the NASDAQ, and some individual companies, some high quality companies that have a fair valuation level. That is my base portfolio. And I use that base portfolio as the backing to be able to sell puts when things are undervalued. That is the name of the game right there. Because if I'm bullish right here, I'm going to sell puts. And if I'm bullish, selling puts is a bullish strategy. If I'm selling puts, I don't want to sit on cash because my cash is sitting there doing nothing. So I'm going to secure the sold puts right here with my base portfolio. I'm bullish on my base portfolio. I think it's going to go up with time. Going to be very volatile in the short term. And on top of that, I'm going to sell put options, roughly a 1 to 2 year expiration date right here to generate a bunch of cash flow. Again, secured by my base portfolio. I'm not collecting margin interest. I'm not actively on margin. It's essentially just like getting a free HELOC on your house. It's pretty crazy to think about it. So when I receive that premium, say I received $30,000 of premium right here from selling 2-year puts, I take that premium and I buy shares of things that I feel like are largely undervalued, that are good companies that are just beat up in price. When the sentiment is bad out there, nobody wants their shares. When the sentiment is bad out there, everybody wants to go buy put options. Like when the market's down, everybody wants downside protection. People just think the market's falling and it's going to keep falling. That is not the time to be scared. That is a time to be greedy. Warren Buffett has said many, many times, be greedy when other people are fearful and be fearful when other people are greedy. But down here, like I was salivating out of the mouth. I was like anybody that I knew, like, guys, the market is largely undervalued. This is a time to deploy capital, and nobody seemed to care. Nobody wanted the market because they just want to look every day and see green. But that's not how you make money in the market. You make money when people panic. You make money when people freak out. And when you have a 2 year time horizon or longer with your leaps and your sold puts, you have this tailwind of earnings per share going up. So down here again, I had the double bullish catalyst. The market was quite a bit of ways below the earnings per share growth line, and earnings per share is also going up and to the right. So when you understand that, you understand that if you do 2 year options right here and you give yourself a little bit of time, you're going to capture that double whammy bullish catalyst and you're going to be just fine. But unfortunately, most retail investors, they do not have the guts to buy down here. They do not have the ability to go against everybody. They don't have the ability to go against the herd, go against everyone that they talk to in their circle. They're just like, oh man, the market's bad today. Like, I hate the stock market. I'm never going to do that again. That is how most people think. But people that are smart and they actually understand how the market works, they know that, hey, this is a good company. It's just beat up because the overall market fell down. I'm going to buy right here and I'm going to sell 2 year puts. I'm going to take that cash flow and I'm going to buy some call options and I'm going to go take that cash flow and buy some shares. And you be patient and you ride out the volatility and you're done with it. I don't claim I could time exact bottoms in the market, but I literally just gave you a 3 year time period right here where you almost could have bought in at any spot in this entire time frame. And if you'd have just held for a couple years, you would have been just fine. When we had a very sharp drawdown right here for Liberation Day tariffs, everybody was panicking right here. I was not. I was panicking to buy right here. Like I was buying calls, I was selling puts because nobody wanted calls down here. So the call options were cheap. Everybody wanted to buy put options down here. So I was selling them the puts for top dollar and I simply capitalized. And once the sentiment flips and the market starts to go back up, those put options that I sold become worthless and those call options that I bought become gold. It's just the same thing time after time again, cycle after cycle after cycle. Now, there is one thing I want to say about this chart right here. This chart is very, very good, but there's no single chart on planet Earth that is the end all be all. I'm going to be honest with you. I plot this chart on every single company that I make a bullish play on, but there are other things that we have to factor in. Valuations, interest rates, the whole macro thesis, what the economy is doing, the labor market. I build a lot of conviction in these trades that I make. And there's often months where I only make like 1 or 2 trades because there's simply not opportunity there. But there's also some months, like if we go back to the chart, there was some times right here where I was making 5 trades a day. Like it really just depends on what's going on out there. And the typical retail investor, they're just like, oh man, I need action. I need to make trades every single day, every single week. But there's just simply not that many table pounder opportunities out there. So when you be patient and you just hold for the long term of quality companies at good prices and do stock options in a reasonable way where you always have your ratios in check so that if you happen to sell a bunch of puts and buy a bunch of calls when the market is cheap but it keeps going down more, you're still going to be fine. My ratios are always in check and there's no scenario where I can ever get wiped out. Longer duration sold puts, longer duration long call options, buying shares, being patient, riding that wave of earnings per share going up. That is the name of the game for this video. Hope you got value from it. If you did, I made another very, very, very good video going a little bit more into this strategy. I know I covered options and some plays really quick here. Go watch this video right there. It's going to help you out a lot, and I'll see you guys there.